Adobe stock crashed on Friday after the company announced earnings. And really, I don't think this is a huge surprise. This is a company that is not growing all that quickly. It's in a very mature market, is getting more competitive by the day with companies like Canva trying to take part of their market. They weren't able to acquire Figma. I think that's a little bit more of an adjacent market, but it's at least going to limit some of the growth that Adobe has. And now the company, I think, is kind of taking some desperate moves to add value to the stock, like announcing a $25 billion stock repurchase program. This is still an incredibly expensive stock. And if the company doesn't pick up growth, the future just doesn't look all that attractive from an investment perspective. So I'm going to dig through some of the numbers. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start this discussion with just a few of the metrics. And I'm recording this over the weekend, but these are the current valuation metrics for Adobe. Price to earnings multiple on a trailing basis is 47. On a forward basis is 27. 27 is a pretty optimistic multiple, but those estimates might change after this earnings report. So we'll see where that lands in a few weeks. The shocking one to me is enterprise value to sales is 11. Now, once a company, even a really, really good company like Adobe, gets to a price to sales multiple above 10, alarm bells should be going off in your head, because that means that the market is pricing in just a ton of growth for a company like this. And that really is in stark contrast to analysts' estimates for forward revenue growth over the next 2 years of 11.3%. So analysts are expecting the business to grow 11%, but the price to sales multiple is 11x. That is just an incredibly rich valuation. That's why the numbers, even if they're really solid for Adobe, can lead to a stock drop like we saw on Friday. I just want to start here with the stock movement. You can see that shares were down almost 14% in trading on Friday. Over the past week, shares are down about 11%, but it's actually been a pretty good year for Adobe, up 37.5%. But keep in mind that this is a company worth $222 billion. So that is the valuation the company needs to live up to based on earnings results. And this is where you get to some of their results, and they're just not all that impressive. Revenue was $5.2 billion for the first fiscal quarter of 2024. That was 11% growth. So remember, that was the projection over the next 2 years from analysts. That's exactly what they hit, 11% growth. Diluted earnings per share on a GAAP basis, $1.36 per share. Now, $1.36, very profitable company. That's great. But shares are still trading for nearly $500 a share. So that's what you have to live up to. And even on a GAAP, non-GAAP basis, $4.48 per share, you end up with a really, really high multiple at the current share price. And this is just fundamentally a challenge. Cash flow from operations, $1.17 billion. And I want to pull up this chart of the company's free cash flow and the trends there, because I think this starts to get pretty alarming pretty quickly. You can see that cash flow has been falling over the last little over a year and is now about $6.5 billion. Now, that number is interesting because management announced a $25 billion stock repurchase program. So can it buy back about 4 years worth of cash flow in stock? And let's look at where the balance sheet sits right now. Here you can see Adobe's $6.8 billion worth of cash on the balance sheet and $2.1 billion worth of debt. That chart actually doesn't quite do the debt justice, because they also have $1.5 billion worth of debt that is current or needs to be repaid within the next year. So really, it's more like $3.6 billion worth of debt. So this is very different than a number of stock repurchase programs that I've covered here on this channel from a number of companies that are positive free cash flow, but are trading for price to earnings multiples more like 8, 9, 10 times earnings or times free cash flow. That's really attractive to buy back your stock at that kind of price. If you're trading for 50 times earnings, or in Adobe's case, 34 times cash flow, that's a really, really expensive price to be buying back stock, especially with such an aggressive stock repurchase program and debt on the balance sheet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I want to dig into a couple of the segments here and some of the individual results. This is Adobe Document Cloud, and this was up 18% year over year, so some pretty positive growth there. You can see already they're talking about AI assistance here in a number of different spaces. Go down to the Creative Cloud. I think this is where a lot of people were expecting artificial intelligence image generation, and the way that Adobe has positioned itself to have artificial intelligence that's trained on its own assets and data. So you know that you're not going to get sued by some sort of creator or photographer for creating derivative works that were actually built by artificial intelligence. That's really the thesis of the case for Adobe, but only up 11% year over year, 12% on a constant currency basis. So kind of across the board, you have middling growth results, and you don't see a ton of evidence that there's a step change in the amount of growth that this company is going to have, driven by some of these new products and new technology that we've seen come to the market. Now, one of the things that's really driven up Adobe stock over the past 18 months or so is the story that artificial intelligence was going to be a growth driver for them long term. And this is one of the things that I want to warn investors about, is that when stocks go up on speculation that the next new thing is going to be a massive growth driver for them, you should be really watching that the business actually reflects that. Not that this is just speculation about something that's going to happen in the future, because I don't know that this is necessarily going to be a big revenue growth driver. There are dozens of places that you can generate images that are not under the Adobe umbrella. I think artificial intelligence could potentially be a disruptor to Adobe, not really necessarily a driver to the company's business. And this is fundamentally the tension that we're facing right now, is that investors have bid up the stock in anticipation that artificial intelligence will drive user growth, revenue per user, but it may actually be the opposite. And if evidence forms that the opposite is the case, and this is a company that's just going to be growing at 10, 11, 12% a year, then the stock doesn't deserve the multiple that it has right now. And I think that's exactly what we're seeing from the market, is that investors are kind of questioning the thesis. Is this really a company that's going to be driven by AI? And I think this is something that we can say for a lot of different technology stocks today. A lot of them have run up over the last 12 to 18 months on the hope that artificial intelligence is going to be some massive growth driver. But now we're at the point where rubber is hitting the road. You need to show that your business is actually being driven by these new markets. Artificial intelligence is actually driving some sort of disruption or keeping disruption at bay. And with results like this, we're getting evidence that that's not the case at Adobe. And if that's not the case, this is a company that should probably be trading more like 15 to 20, maybe even 25 times earnings, not 50 times earnings. So I think could potentially have a long ways to fall for Adobe. This is one of those stocks. I did a video months ago at this point that said, this is a company that I love the company, but I don't like the stock. And I think that still holds true today, given where the stock price is. I think it's just way too expensive for investors. We see that any sort of miss of expectations or even talking about the wrong things on a conference call can send a stock like Adobe falling, even at the valuation that it is today. So beware of this for not only Adobe, but other companies that are trading for extremely high multiples, because the market looks very frothy, especially in the artificial intelligence space. But what do you think about the results and the market's reaction? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.